Hey, welcome back to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Wednesday, February 8th. And joining me as always, my friend, my colleague, one of the best in the business, Dr. Orphe Divounguy, a PhD economist who's getting all kinds of love in the media lately. My goodness. Everywhere I look, I see Dr. O, please tell me something. Dr. O, make sense of this nonsense for me.
We're trying on this podcast. We're trying. And if you're not subscribed, please subscribe. Please hit the like button wherever you watch this stuff or listen to our podcast. We come to you with the facts, and we try to make sense of all this stuff.
One thing I want to talk about that you and I haven't really talked about in between considerations for what the Federal Reserve might do is sort of like, the Fed came out and within the last week and said, okay, 25 basis points. I think everybody cheered. The market really liked that. I think some people felt like, yes, we've reached the bottom and it's all up and away from here. And I was thinking, gee whiz, that is not what this is all about. When you're applying the brakes, you can do it gradually or you can panic brake. We've had a lot of panic braking, and this was maybe a little bit a softer touch on the brakes, but we're not out of the woods here by any stretch of the imagination.
I'm worried. And I'm an optimist.
That makes me worry when the optimist on the other side of this line here is worried.
Yeah, I start to worry. I start to worry because Chair Powell comes out and says the process of getting to 2% inflation is going to take a long time. He's aiming directly at the labor market. Yes, the labor market is showing some resilience. Okay. We had this recent jobs report, 517,000 jobs in January, a bunch of them coming from leisure and hospitality. So services still very strong. Food and drinking places. I don't know who goes to food and drinking places these days, but yeah. A strong labor market, and the Fed, despite all of the leading indicators that are showing that the U.S. economy is slowing rapidly, despite the CPI number showing inflation, right? The CPI, Consumer Price Index, year over year, showing inflation is already decelerating rapidly. Despite inflation expectations falling, despite rent inflation, right? We look at market rents have decreased tremendously. House prices have already slowed considerably. Month over month rent growth is declining despite all of that, right? Which, by the way, market rent leads CPI rent by roughly a year. So we expect all of these factors to play a role. Rent is 40% of core CPI. Again, all of those factors mean inflation is coming down, and inflation has come down a lot since the 9% peak this past summer. And yet the Fed, focused on the labor market, could continue to raise interest rates. And I think that's worrying. That's worrying because it could end up making another mistake. Fed policy could end up pushing the U.S. economy into a recession. And it's not just me who says that, by the way. This month, last week, Duke University professor Kemp Harvey, who's also known for showing the world that an inverted yield curve was a reliable signal for forecasting recession. He led the chorus by pointing out that further Fed action could be a historic mistake, a type of own goal. And yes, I'm beginning to be a little worried that the Fed's obsession for the relationship, the historic relationship between, or at least in theory, between inflation and the unemployment rate still holds. And it doesn't. It doesn't. I mean, a lot of economists are coming out saying, look, the relationship between inflation and the unemployment seems to be broken. There were some revisions to 2022 numbers that actually showed the labor market was even hotter than expected in 2022, and still inflation came down substantially. The Fed should begin to feel good about inflation coming down and not focus so much on the unemployment rate to begin to think it has won the war on inflation. I think the war on inflation is almost won. Remember, things are moving fast in the economy. It's very dynamic. And inflation is decelerating rapidly. And so further action could actually push us into a recession, push us into that hard landing. The hard landing could completely be avoided today, and the Fed has to be very careful. Final point, remember that there are huge lags between monetary policy and its impact on the economy. And the economy is already slowing. If I were the Fed, I wouldn't focus so much on that unemployment rate. I wouldn't focus so much on that because, again, it's not going to tell us very much. Again, because of course, we still have a lot of people that are on the sidelines. If they came back in, they're not working. If they came back in, the unemployment rate would shoot right up. I wouldn't be focused so much on the labor market. I would focus squarely on inflation. The inflation is coming down. That's a good thing. The Fed should be happy about that. But a Fed that is a little too hawkish, that is more aggressive, could really push us into a recession.
As always, I appreciate your thoughts, and just one stat to send us off that, if you're not keeping score at home, the Fed has raised rates by 4.5 percentage points over the last 12 months, which is the most since the 1980s. Thanks again, Orphe, for everything. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.